What if the Federal Reserve's rate cuts in 2024 could lead us right into a recession?
That's a question on many investors' minds right now. Understanding the balance between opportunity and risk is key.
Welcome to Financial Insights in Minutes, where we summarize the essential financial news of the day.
Today, we will explore varying opinions on the housing market, rising interest rates, and investment strategies ahead.
Let's dive into the highlights of today's top financial content. Today, we explore a hot topic from Reventure Consulting, focusing on the Federal Reserve's recent interest rate cut announcement. Prepare to navigate some potentially choppy economic waters.
Indeed, there's a lot to unpack here, especially considering the historical correlations between rate cuts and recessions. Viewers should be ready for a financial deep dive.
Let's get right into the thesis. What should viewers take away from this?
The key takeaway is that historically, when the Fed cuts interest rates, the economy tends to spiral into a recession. 11 out of 15 rate cuts have preceded this dreaded outcome.
Digging deeper, let's look at historical data. What do the numbers say?
Right, out of the last 15 rate cuts, 11 have led to recessions. That's a 70% chance of economic decline afterward.
And what about the labor market? How does it factor in?
The unemployment rate rose sharply to 4.3%, with millions of Americans facing job losses, a clear indicator of an impending recession.
Let's talk debt. What's going on with national and personal savings levels?
America's debt-to-GDP ratio is at a staggering 123%, and personal savings sit at a mere 3.4%, indicating a risky financial environment.
How are the housing stats looking amidst these cuts?
The housing market bubble is at an alarming 176% of GDP, yet mortgage applications are plummeting.
What about the stock market? What's the risk there?
Stocks are currently overvalued at 200% of GDP, leading to exceptionally high future risk levels if the economy worsens.
Now it's time for some predictions. What does the future hold?
Expect an impending recession. Job losses could significantly increase, and we may see both housing and stocks undergoing major corrections.
Will we see any shifts in policy?
Absolutely. The recession indicators will likely force policymakers to reconsider their strategies and decisions.
To wrap up, what should our viewers take away?
A cautious approach is advised. Rate cuts have historically led to recession, a trend that may spell trouble ahead for us all.
And now, what do you think? Will the Fed's move spark a recession or save the economy? Let us know in the comments.
We can't wait to read your predictions and insights. Let's keep the discussion going.
Welcome to Ken McElroy's YouTube channel. Today, we're diving into transformative strategies on how to turn a crisis into an opportunity for generational wealth. Joining us is the legendary Robert Kiyosaki, author of Rich Dad, Poor Dad, and a prominent investor.
Let's get straight to the facts. Robert will share insights on leveraging the current economic turmoil to build wealth and how entrepreneurs can seize opportunities in turbulent times. Stick around, there's a goldmine of information ahead.
So what's the core message from Robert Kiyosaki's insights today?
The central thesis is that amid economic uncertainty and polarization, especially with upcoming elections, there are abundant opportunities for those who think like entrepreneurs. It's a time to invest wisely and creatively.
What's the first key point Robert emphasizes?
He underscores the need for an entrepreneurial mindset. People often miss out on opportunities because they don't think like entrepreneurs. Today's technology gives entrepreneurs unprecedented power and reach.
What about investments? What does Robert suggest?
Kiyosaki highlights that hard assets like real estate, gold, and silver are excellent investment opportunities. For instance, home prices have jumped from $350,000 to $450,000 over just 3 years.
And how about understanding the economic landscape?
It's crucial. With inflation rates affecting everything from commodities to housing, recognizing these trends can put you ahead in the investment game.
What predictions does Robert make for the future?
He anticipates ongoing economic turbulence and a growing interest in hard assets as more people look to hedge against inflation.
To wrap it up, what's the main takeaway?
The key message is to recognize that crises can lead to remarkable opportunities. By investing in hard assets and thinking big, anyone can turn their financial situation around.
As we conclude, we want to know, what strategies resonate with you? Do you have your own tips for turning crises into wealth?
Drop your comments below. Let's spark a discussion on strategies to navigate these uncertain waters together.
Welcome back to Real Estate Mindset. Today, we'll be exploring a brewing storm in the housing market. What's causing the perfect storm for a looming foreclosure catastrophe? Joining us to provide some insight is community expert Melody Wright.
Great to be here. There's so much data indicating that we need to start paying attention now more than ever.
So what's at the core of today's discussion?
The core thesis is alarming. An increase in foreclosures is on the horizon, fueled by misinformation about mortgage delinquency. While some reports show modest figures, the truth underneath indicates a much graver situation.
Let's tackle the first key point, the distortions in delinquency data. Can you explain how this variation is impacting perceptions?
Absolutely. These discrepancies are significant. While one service reports a specific number, others are suggesting much higher. This creates a false sense of security for homeowners.
Next, let's tackle those underwater mortgages. What's the situation like, especially in Texas?
Well, Texas homeowners face crippling property taxes. With more than 1 million underwater, it's a ticking time bomb fueled by misleading assurances about housing stability.
And what about loan modifications? How do they factor in regarding the potential crisis?
They are crucial. The way modifications suppress delinquency statistics might lull the market into complacency, masking the dire need for genuine intervention.
Speculation can be a tricky aspect. Can you elaborate on how it's playing a role now?
Certainly, speculation creates waves. When the market dips, these investors begin offloading properties, which only exacerbates downward pressures on prices.
Now, let's look into predictions. What does the future hold?
It's expected that as interest rates climb and negative equity persists, a significant increase in foreclosures will occur within a year.
And long-term, what should we anticipate?
There must be a correction, but whether it occurs through natural market forces or government intervention remains to be seen.
What's the big takeaway from today's talk?
The biggest takeaway is to remain informed. Awareness of delinquency metrics and market conditions is essential for navigating the rocky waters ahead.
And transparency seems to be a recurring theme.
Absolutely. Transparency in reporting will govern how we can prepare for what's coming, rather than being blindsided by unanticipated shifts.
So, what do you think? Are we heading towards a foreclosure crisis?
Drop your thoughts in the comments. Start the conversation on these pressing issues that might hit closer to home than expected.
Welcome to Christina Smallhorn's YouTube channel. Today, we're diving into the rapid decline in mortgage rates and what it could mean for homebuyers.
That's right. Joining us is Kyle Seagraves, an expert mortgage lender who will clarify some common misconceptions about mortgage rates and the Fed's influence.
So what's the main thesis of today's discussion?
The core thesis is that while mortgage rates are dropping, many misconceptions exist regarding how Fed rate cuts impact these rates. Kyle will clarify what's really going on.
Let's talk about the misconceptions regarding the Fed's role. What do people commonly misunderstand?
Most folks think that when the Fed cuts rates, mortgage rates will drop accordingly, but that's not entirely true. The Fed controls short-term lending rates, not long-term mortgage rates.
How's the current real estate market looking?
While we see a growing supply of homes, demand hasn't kept pace. Many buyers are staying on the sidelines hoping for even lower rates.
And what about inflation? How does it impact mortgage rates?
Inflation plays a huge role. When inflation rises, mortgage rates typically follow. A drop in inflation might mean a stabilization of these rates.
What are the predictions for future mortgage rates?
While rates may decrease modestly, we're likely looking at an average of 5 to 6% in a healthier market, rather than returning to the lows seen in the past.
Now let's talk about future predictions for mortgage rates.
We're likely to see stabilization around 5 to 6% in the coming months, driven by ongoing inflation trends.
And what about the Fed's decisions? How might they play out?
While the Fed's actions will influence market outlooks, misconceptions will lead to continued speculation, even if rates don't drop as much as expected.
What's the big takeaway for today's session?
The key takeaway? Understanding mortgage rates requires awareness of inflation and market conditions, not just focus on Fed actions. Homebuyers need to be prepared.
And what should homebuyers do moving forward?
Engage with knowledgeable mortgage professionals to understand how these rates will truly impact their purchasing decisions.
We want to hear from you. What do you think about future mortgage rates?
Leave your thoughts in the comments below. Let's keep this discussion going.
Welcome to the Bigger Pockets podcast. Today's remarkable story features Brandon Tilson, a social worker turned successful real estate investor. Sounds intriguing, right?
Absolutely. Brandon started investing just 2.5 years ago and now owns 8 rental properties, all while maintaining a busy work-life balance. It's about to get inspiring.
So what's the gist of Brandon's journey?
The core thesis is that real estate investing is not only possible, but can be lucrative, even amid economic challenges. Brandon shows us that with dedication and the right strategy, anyone can achieve financial independence.
Let's dive into those key points. How did Brandon make his entry into real estate?
Brandon started by recognizing the potential of real estate as a way out of the 9-to-5 grind. After some initial struggles with his first deal, he learned quickly and adapted.
Now, what about his portfolio management?
Brandon leverages various jobs and has a unique approach by self-managing his rentals to maximize profits. It's all about stacking those income streams.
Interesting goals. What's next on his horizon?
He's striving for financial independence through strategic investments and aims to retire early to enjoy life with his family. The blend of finance and family is key.
Looking ahead, what predictions does Brandon have?
He anticipates fluctuating market conditions due to interest rates, but believes ripe opportunities will eventually emerge. Staying educated on the market is crucial.
And how does he plan to grow?
Brandon plans to consistently expand his property portfolio, aiming to acquire several more properties per year, always learning, adapting, and connecting.
As we summarize Brandon's journey, what's the big takeaway?
It's clear that with perseverance and the right strategies, anyone can achieve financial goals through real estate, even while facing life's challenges.
So what's crucial for aspiring investors?
Engaging with communities like Bigger Pockets provides resources and support necessary for success. Never underestimate the power of networking.
Finally, we want to hear your thoughts. What do you think about Brandon's path to financial freedom?
Drop your comments below and let's discuss how we can all navigate the currents of real estate investing together.
Welcome to Jason Walters' channel, where today we're diving into new home sales and their surprising jump in July. Are we seeing a shift in the housing market?
Absolutely. We've got some fascinating insights from the latest report on new home sales. Grab your life jackets. It's time to navigate these waters.
So what's the main story about new home sales?
The core thesis reveals a striking rebound in home sales in July, with a rise of over 11% compared to June, defying earlier expectations.
Let's break down this sales surge. How many new homes sold last month?
A whopping 739,000. That's way above the forecast, signaling that the housing market is thriving.
What about regional trends? Are all parts of the country celebrating?
Not quite. The West shines with a 34% spike in sales. Meanwhile, the South barely nudged up. Talk about regional disparity.
What's driving this sales surge?
A big factor is the drop in interest rates. We're currently at 6.85%, and buyers are loving the opportunity.
What's the scoop on builder incentives?
Builders are slashing prices and offering attractive deals. Over 61% are providing sales incentives. It's like Black Friday in July.
And inventory levels?
They've decreased to 462,000, lowest since January. Fewer homes mean more competition among buyers.
Looking ahead, what's next for new home sales?
If interest rates stay favorable, we might see more sales growth. Builder confidence could finally improve.
To wrap up, what are the key takeaways from this discussion?
The surge in home sales demonstrates the market responding positively to lower rates and strategic builder incentives. It's an exciting time for buyers.
What's your prediction for next month's sales?
Let us know in the comments. Your insights could shape the conversation about the market's future.
Welcome to Ryan Scribner's channel on YouTube. Today's discussion takes us into the world of business checking accounts. Is your business a side hustle or an established operation? Either way, it's time to separate those transactions and boost your financial game.
Absolutely. Today's discussion revolves around opening your very first business checking account. featuring the innovative Relay platform. Exciting insights are coming up.
What's at the heart of today's discussion? What should we take away from Ryan's insights?
The core thesis is straightforward. Opening a business checking account isn't just a formality. It's essential for legal protection and managing expenses efficiently. Ready to explore why this matters?
Let's navigate through the vital key points. First up, why is separating finances so crucial?
It's all about protection. Having a separate business account shields your personal assets from any liabilities that may arise. Plus, it keeps your expense tracking organized. It's like having a life raft in tumultuous waters.
About those account options, what should business owners keep in mind?
Not all accounts are the same, and features can vary drastically. Some banks might distract you with low annual percentage yields. Always watch for hidden fees. It's like pirates hiding treasure.
Now, let's dive into why Relay stands out. What unique tools does it offer?
Relay is a game changer. No monthly fees, up to 20 separate accounts, and integrations with bookkeeping tools that save time. It's the Swiss Army knife of banking.
What kind of paperwork is needed to open these accounts?
You'll need an EIN or sometimes your personal social security number. Also, proper documentation is key. No one wants to be caught without the right papers in hand.
Any predictions for how business banking may change in the coming years?
Expect fintech platforms like Relay to keep gaining traction. Traditional banks might either adapt or could find themselves sailing into troubled waters.
As we anchor this discussion, what key takeaways should viewers keep in mind?
Remember, opening a business checking account is essential for legal protection and improving overall financial efficiency. Don't forget to leave us your thoughts and questions in the comments below.
And now we want to hear from you. How do you see the future of fintech banking?
Comment below with your insights. Your opinions could shape our next conversation on the changing tides of business banking.
Welcome to Bigger Pockets. Today we're diving into how to find the right lender for your investment properties, featuring a special guest who knows all the ins and outs, Jeff Wan, an experienced lender who has been in the game for over 20 years.
Absolutely. Jeff brings a wealth of knowledge from working with real estate investors and has a track record that speaks volumes. Get ready to gather some invaluable insights today.
So, what's the heart of today's discussion?
The thesis. It's imperative to partner with an investor-friendly lender who understands the unique challenges you face as a real estate investor.
Let's unpack those key questions to ask lenders.
First, inquire about their experience. You want someone who thrives in the investor landscape. Second, ask how many transactions involve investors, because a specialist makes all the difference.
Now let's talk about why experience counts.
Absolutely. Inexperienced lenders can lead to pitfalls that cost you dearly, while an experienced one can streamline the process significantly.
Let's explore how referrals can aid your search.
Referrals are invaluable. Connecting with fellow investors can uncover trustworthy lenders. Bigger Pockets has a great lender finder, too.
Now on to loan types. How do they impact your strategy?
Right? Each investment strategy requires different loan types. Understanding those nuances helps you select the right lender for your needs.
And what about the house hack strategy?
House hacking is a fantastic way to get into the market with a minimal down payment and utilize grants to offset your costs. Maximize profit while minimizing payments.
What about market predictions moving forward?
With rates potentially decreasing, we could see an uptick in investor activity. Lower rates could mean more deals up for grabs.
And what about opportunities for investors?
Investors could seize upcoming opportunities as properties hit the market at decreased prices. Less competition means more chances to close deals.
What are the main takeaways from today?
Finding a knowledgeable lender is key. They can guide you through the complexities of the real estate market and ensure your strategy is on point. It's not just about rates, it's about relationships.
Any final thoughts on engaging lenders?
Absolutely. Explore your options, ask the right questions, and dig into referrals. What are your insights or questions? Let us know in the comments below.
Today, experts shared diverse insights on the approaching financial landscape in 2024.
Key themes included the risks of recession alongside emerging investment opportunities, particularly in the housing market.
Engaging thoughtfully with the information shared will be vital as we adapt to changes.
Thank you for joining us. Be sure to subscribe for more essential financial updates.
Thanks for watching Financial Insights in Minutes for August 26th, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.